The most recent release of US house prices data for December 2015, i.e. the Shiller 10 City Composite, continues to show little change at 197.2 against 197.4 of 4 months earlier, which means that US house price inflation spent virtually the whole of 2015 within a tight range of between plus 4% and plus 5%, which, while stable, is nevertheless a far cry from early 2014 that had house price inflation galloping ahead at near 14% per annum, as illustrated by the momentum graph. So, despite house prices having ended 2015 about 5% higher, apparently the US housing market is still on the precipice of a bear market, collapse, crash, or even worse. And one does not have to look far for such prevalent housing market doom. Even much of the mainstream press is infected with such expectations, as pundits have taken the prospects of a US economic slowdown as further signs for the imminent demise of the US housing market, latching onto the likes of Saudi Arabia's war on the US oil shale industry, China's fast decelerating economy, and then we have the prospects for a further Fed interest rate hikes during 2016. The only problem for the doom merchants is that they have been banging the same drum for the duration of the housing bull market that has literally ridden a wall of worry for near 4 years now, since the early 2012 bottom. And where market commentators are concerned, rather than listing a long series of pronouncements from those who in large part will be unknown to most viewers, I would just focus on the widely recognized king of the US housing market data, Professor Robert Shiller, who has been consistent in warning not just against high housing market valuations but also for stocks. To further illustrate the point, Robert Shiller's recent comments are pretty similar to those he was stating 18 months ago. So what do academics repeatedly miss? They miss the significance of momentum and sentiment on trend, which is accumulative, as I've covered many times over the years. So enough of the academic noise that the mainstream press tends to regurgitate as academic theories and sales pitches from the financial industry. Instead, here is my real take on the current state of the US housing market in terms of price momentum, for at the end of the day all that matters is what the price is doing. But firstly, here's a recap of my long-standing forecast for US house prices covering the period from November 2012 to March 2016, which is now entering its last few months. My forecast conclusion is for US house prices to experience an accelerating trend over the coming years, as each year's percentage gain prompts higher gains in the following year as a consequence of ever improving market sentiment that will lead all the way to the next bubble, which is many years from now. Therefore, my forecast conclusion is for the embryonic bull market of 2012 to morph into a real terms bull market of 2013, where each year builds on the preceding year's momentum all the way towards an average price gain of over 30% by 2016. This translates into a precise forecast for the Shiller CXSR index to rise from the most recently released data of 158.8 released in December 2012 for October 2012 to target a rise to 207 by early 2016, or a gain of 30.4%. There are several potential ways to play the unfolding housing bull market, the lowest risk of which is to buy a house to live in. The next riskiest would be to buy to let as a landlord, and the highest risk being to buy bank and house builder stocks. which tend to be highly leveraged to house prices. Before you all rush out and buy, a word of caution. That is that I am anti-borrowing money, so don't make the same mistake as many made during the last housing bull market, which was to fall for the bankster con of getting you addicted to lots of cheap money and then taking the drug away and then waiting to foreclose when you can't make payments on your mortgage. And the latest US house prices data released for December 2015 of 197.21 shows that US house prices are currently showing a minus 2.5% deviation against my trend forecast as it enters its final 3 months. And as for home building stocks, the XHB chart shows that the home builder stocks tend to underperform the Dow average when house prices momentum slows, and then tends to outperform when house price momentum accelerates, as house price momentum has been slow for the past 4 months on the most recent release, and so the XHB has underperformed. However, overall the XHB is not flashing any significant warning signals of the prospects for doom being just around the corner. So yes, home builder stocks are weak, but so is house price inflation in its current range of plus 4% to plus 5%, which is set against plus 14% of 2 years ago, with little sign that home builders are set to outperform the Dow average, which implies neither to expect house price momentum to surge higher anytime soon. And apparently the US is going to raise interest rates by between 3 to 5 times this year, which has been taken by the perma-doom crowd as clear harbingers of an end to the US housing bull market. Whilst my take on US interest rates is pending an in-depth analysis, however, as for what impact are rising interest rates likely to have on the US housing market, well, rising rates are going to act as an incentive to get all those who have been sat on the fence watching and waiting for perhaps house prices to fall to finally buy before mortgage rates rise. So in fact, for 2016 at least, the prospects for rising interest rates, whether they actually materialize or not, is a net positive for the US housing market, which again is contrary to the consensus view. So, are the doom merchants finally about to be proven correct? Are US house prices on the edge of collapse, where literally any one of a number of possible bad news events could tip house prices over the edge of a cliff? Or is the US housing bull market likely to end 2016 with another year of decent gains? Well, whilst my detailed multi-trend forecast is pending completion of further intermarket analysis such as US interest rates, economy and the dollar, however, ongoing accumulative analysis does not suggest that an end of the bull market, let alone crash, is on the horizon for the whole of 2016. Whilst the momentum chart clearly demonstrates stable, well-supported house prices in the range of plus 4% to plus 5%, and with this being an election year, implies to expect marginal strength for 2016, thus targeting a gain of at least 5% for the year. So when the dust settles by the end of this year or early March 2017 when the actual data is released, US house prices will likely end 2016 with another year of stable, sustainable gains of at least 5% and probably nearer to 6%. So 2016 looks like turning out to be another year when the doom merchants will once more be found banging their heads against a solid brick wall. However, do ensure you're subscribed to this YouTube channel for my detailed trend forecast for US house prices that will once more seek to map out a multi-year trend forecast for at least the next 3 years, as well as the following.